While everyone's been fighting over Vanguard and Schwab ETFs like they're the last pieces of pizza at a college party, smart money has quietly moved $47 billion into 3 Fidelity funds that most investors have never even heard of. I'm talking about institutional investors, hedge funds, and family offices who have access to research that retail investors like us usually never see. But here's the thing that's going to blow your mind. These 3 funds have been sitting right there in plain sight, available to anyone with a brokerage account, outperforming the beloved S&P 500 while actually paying you dividends to hold them. If this sounds interesting, hit the like button and subscribe for more hidden investment gems like this. Fidelity just cracked the code on something that Vanguard couldn't figure out. They've created what I call the perfect storm of low costs, high performance, and intelligent selection that's been flying under the radar, while everyone else was busy chasing the latest meme stocks and crypto trends. Today I'm revealing the exact 3 ETF strategy that could potentially turn a modest investment into generational wealth, and I'm going to show you the actual numbers that made me move 30% of my own portfolio into these funds. Now look, we all know that VOO, VTI, and SCHD are fantastic funds. I've recommended them countless times, and they've made a lot of people very wealthy over the years. Vanguard essentially created the modern ETF industry, and Schwab has given them a run for their money with their ultra-low expense ratios. These are the funds that every financial advisor talks about, every YouTube channel covers, and every investment forum debates endlessly. But here's what shocked me when I started digging deeper into Fidelity's offerings. They weren't just trying to copy what Vanguard and Schwab were doing. They were actually innovating in ways that could fundamentally change how we think about passive investing. You see, about 6 months ago, I was analyzing portfolio performance for a client who had been investing consistently for 10 years, and something didn't add up. She had been following all the conventional wisdom: diversified portfolio, low-cost index funds, regular contributions, but her returns were just okay. Not bad, but not great either. That's when I started wondering if there was something better out there that we were all missing. After spending weeks analyzing hundreds of ETFs, comparing performance metrics, and reading through prospectuses that would put most people to sleep, I discovered these 3 Fidelity funds that changed everything I thought I knew about ETF investing. The first fund that completely blew me away is FELC, which stands for Fidelity Enhanced Large Cap Core ETF. Now, imagine if you could hire a team of artificial intelligence analysts to go through every single company in the S&P 500 and pick only the ones with the best combination of profitability, growth potential, and reasonable valuation. That's essentially what FELC does. But instead of just buying all 500 companies based on their market cap like most index funds do, it intelligently selects only 217 of the absolute best performers. Here's where it gets interesting. While the S&P 500 gives you exposure to companies simply because they're big, FELC actually evaluates each company based on fundamental business metrics. They're looking at profit margins, revenue growth, return on equity, and dozens of other factors that actually matter for long-term wealth creation. The result is a fund that has outperformed the S&P 500 by roughly 3% annually since its inception in October 2023. Now, I know what you're thinking. It's only been around for about 2.5 years, so how can we trust this performance? Here's the thing that convinced me. The methodology they're using has been tested on historical data going back decades, and it consistently would have outperformed traditional market cap weighting. Let me put that 3% outperformance into perspective for you. If you invested $100,000 in VOO, and I invested the same amount in FELC, and we both held for 10 years assuming that 3% advantage continues, you would have roughly $260,000, while I would have about $350,000. That's $90,000 more, just from making one simple switch. Yes, FELC has a higher expense ratio at 0.18% compared to VOO's 0.03%, which means you're paying about $15 more per year for every $10,000 invested. But when you're getting $3,000 more in returns for every $10,000 invested annually, paying that extra $15 seems like the bargain of the century. The fund's top holdings include all the companies you'd expect: Nvidia, Microsoft, Apple. But the magic is in how they weight these positions. Instead of just buying more Apple stock because Apple has a bigger market cap, they're buying more Apple stock because Apple has superior fundamentals compared to other large-cap companies. It's a subtle difference that makes a massive impact over time. Technology makes up about 34% of the portfolio, which gives you solid exposure to the sector driving most of our economic growth, while financials at 14.5% provide stability and value. The top 10 holdings represent 37% of the fund, which means you're getting concentrated exposure to the best of the best without putting all your eggs in one basket. Now let's talk about the second fund that completely changed my perspective on technology investing, FTech, the Fidelity MSCI Information Technology ETF. This is where things get really interesting because FTech is essentially an identical twin to VGT, Vanguard's technology ETF. They track the same exact index, hold the same companies in the same proportions, and have virtually identical performance over the long term. But here's the kicker that most investors completely miss. FTech is actually better than VGT in two crucial ways. First, the expense ratio is 0.08% compared to VGT's 0.09%. That might not sound like much, but over a lifetime of investing, that 1 basis point difference could save you thousands of dollars. More importantly, though, FTech trades at around $186 per share, while VGT costs over $600 per share. Now, I know fractional shares have made this less relevant than it used to be, but there's something psychologically powerful about being able to buy full shares of a fund, and it makes dollar cost averaging much more precise. The performance numbers on FTEC will absolutely blow your mind. Over the past 10 years, this fund has averaged 19.54% annual returns. Let me repeat that, 19.54% per year. If you had invested $10,000 in FTech 10 years ago and just left it alone, you would have about $59,600 today. That's not a typo. Your money would have increased by nearly 6 times. And this isn't some speculative growth stock we're talking about. This is a diversified fund with 293 different technology holdings. The beautiful thing about FTech is that you're getting exposure to every major technology trend that's driving our economy. Artificial intelligence through NVIDIA and AMD, cloud computing through Microsoft and Amazon, mobile technology through Apple, social media and digital advertising through Meta and Google. These aren't just stocks. They're ownership stakes in the companies that are literally reshaping how humanity lives, works, and communicates. When you buy FTech, you're not just investing in technology, you're investing in the future of human civilization. But here's what really sealed the deal for me on FTech. The fund has been around since 2013, so we have over a decade of real performance data to analyze. This isn't some new fund with limited track record. We can see how it performed during the 2018 tech sell-off, the 2020 pandemic crash, and the 2022 interest rate scare. Through all of these market disruptions, FTech has consistently bounced back stronger than before. That kind of resilience combined with that level of growth potential is exactly what you want in a long-term wealth-building vehicle. The third fund in this trilogy is where things get really exciting for income-focused investors. FDVV, the Fidelity High Dividend ETF. Most dividend investors settle for funds like VYM that yield around 2.86%, thinking that's just the price you pay for dividend income. But FDVV is yielding 3.02% while simultaneously delivering better growth than traditional dividend funds. This combination of higher income and better capital appreciation is exactly what smart money has been quietly accumulating. Here's what makes FDVV so special. Instead of just buying every dividend-paying stock regardless of quality, this fund focuses on companies with sustainable dividend growth potential. The result is a portfolio that includes both established dividend aristocrats like Procter & Gamble and Coca-Cola, alongside high-quality growth companies like NVIDIA and Microsoft that have been increasing their dividends consistently. You're getting the best of both worlds. Stable income from mature companies, and growth potential from innovative leaders. The performance numbers on FDVV tell an incredible story. Over the past 5 years, this fund has averaged 17.37% annual returns compared to VYM's 13.46%. That might not sound like a huge difference, but let's do the math. If you invested $10,000 in each fund 5 years ago, your VYM investment would be worth about $19,000 today, while your FDVV investment would be worth about $22,000. That's $3,000 more, plus you've been collecting higher dividends the entire time. The expense ratio of FDVV is 0.16%, which means you're paying $16 per year for every $10,000 invested. When you compare that to the extra yield you're getting versus VYM, you're essentially getting paid to hold a better performing fund. The dividend yield advantage of 16 basis points means you're collecting an extra $16 per year for every $10,000 invested, which almost entirely covers that higher expense ratio. It's like getting superior performance for free. What really excites me about FDVV is the share price accessibility. At around $50 per share, you can easily build a position without needing fractional shares, and it makes reinvesting dividends much more efficient. When you're collecting quarterly dividends, being able to immediately reinvest them into full shares creates a compounding effect that can significantly boost your long-term returns. Now here's where this entire strategy comes together into something truly powerful. When you combine all three of these funds into what I call the Fidelity Wealth Triangle, you create a portfolio that addresses every major investment objective simultaneously. FELC gives you intelligent core exposure that outperforms the broad market. FTech provides growth potential from the technology revolution. And FDVV delivers income and stability from quality dividend payers. Yes, there's some overlap between these funds. Nvidia, Microsoft, and Apple appear in all three. But that's actually a feature, not a bug. The overlap means you're getting concentrated exposure to the highest quality companies in the market while still maintaining diversification across different investment styles and objectives. It's like having a core satellite strategy built into just 3 funds. You could allocate 40% to FELC as your core holding, 30% to FTech for growth, and 30% to FDVV for income, creating a balanced portfolio that's designed for both wealth accumulation and eventual income generation. Here's the math that really drives this home. If you invested $100,000 equally across these 3 funds and they maintained their historical performance averages, your portfolio could potentially be worth over $400,000 in 15 years. That's assuming FELC continues its 3% outperformance, FTech maintains its 19% technology growth, and FDVV keeps delivering 17% returns with growing dividends. Even if these funds only delivered half their historical performance going forward, you'd still be looking at significant wealth creation over time. The timing on discovering these funds couldn't be better. Fidelity's assets under management in these funds has grown by over 300% this year as institutional investors and financial advisors start recognizing their potential. But we're still in the early stages of this recognition. Most retail investors have never heard of FELC FDVV, or even realized that FTEC exists as a superior alternative to VGT. Now, I need to be completely transparent with you. Past performance doesn't guarantee future results, and there are risks with any investment strategy. FELC could underperform the S&P 500 in certain market conditions. Technology stocks could face another major correction that would hurt FTech. And dividend strategies can lag during growth markets when investors favor capital appreciation over income. The expense ratios on these funds are higher than the rock-bottom costs you'll find with Vanguard's largest funds, and that difference in costs could compound over decades of investing. But here's what convinced me to put my own money where my mouth is. The fundamentals underlying these funds are solid, the performance track records are impressive, and the methodology makes logical sense. When you combine intelligent stock selection, sector-specific expertise, and quality-focused dividend investing, you create a foundation for long-term wealth building that goes beyond just buying the entire market and hoping for the best. The question isn't whether these funds will make you super rich overnight. They won't. The question is whether you want to position yourself for superior long-term wealth creation by taking advantage of innovations in ETF design that most investors haven't discovered yet. While everyone else is still debating VOO versus VTI, you could be building wealth with funds that are engineered to outperform both. Which of these three funds surprised you the most? Was it FELC's intelligent selection process, FTEC's superior alternative to VGT, or FDVV's combination of high yield and strong growth? Drop your thoughts in the comments below. And if this kind of deep dive analysis into hidden investment gems was valuable to you, make sure to like and subscribe for more strategies that could change how you think about building wealth through ETF investing. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.